Okay, we're being recorded, so Brooks, watch your mouth. So, okay, so we finished chapter 14, and that was forming a partnership, and we went through those exercises. Did anybody have any questions about them before we move forward? Anybody? Okay. I don't know if any of you are looking at those videos before we come to class or before we have our time together. If you're able to go through some of those exercises through the video. Yes, no, some of you, yeah, all right. Then we'll just move into chapter 15, if that's okay. So 14, we put the partnership together, and then 15, we're gonna shut it down. So, and of course, as I would have mentioned, if I had you face to face, forming a partnership is always a whole lot more fun. People are still happy. It's usually when we have to shut it down, it's not going well, right? I mean, we don't ever really shut down a partnership when things are going great and we're making lots of money. It's usually because they're not making any money or their partners are fighting. So usually this is quite tense, and we have to make sure we do this fairly. So what I'm going to do here is I'm going to share my screen. If I can figure that out again. Here we go. Can you all see my screen? All right, thank you, Macy. Okay, so rats, I didn't realize I did this separately for every one of them. Number 12. Let's look at number 12. It is on page 725, and it reads, a partnership has the following account balances. So they got cash, other assets, liabilities, and then their capital. Nixon, Cleveland, and Pierce. And it's laid out here on the problem, the reported balances, Nixon, Cleveland, Pierce, 170, 110, and 70. It says the company liquidates and $8,000 becomes available. Who gets it? So what they first talk about is what is safe? What is safe payments? And the reason they go into this in great detail is because if we over distribute, the truth of the matter is they're not happy the way it is. And if somebody's already insolvent, meaning that they've got more debt than they're worth, and they get the money, it's highly unlikely that they'd be able to give it back if there was a notice of overpayment or miscalculation or however you want to call it. So we want to be as safe as possible. So in this case, it said they had, so if you look here, they had other assets of $540,000 and liabilities of $260,000. And in the chapter, it says here, what is their safe payments? They have $8,000. So if you take that $350,000 asset that they have, and or excuse me, the total capital is $350,000. Total capital is $350,000, and we're going to say essentially that's all they've got. And now $8,000 came up. The difference between the $350,000 and that $8,000 is the $342,000. So that's a maximum loss. That's everything, because your assets less those liabilities is $350,000, and now they only have $8,000 to give away. So who's going to get it? And of course, that's very, very conservative, right? Because hopefully they're going to get something for those other assets in excess of the liabilities. Well, in this case, we're going to say there's a $342,000 loss. Okay, So how are we going to split that? It's going to be split on their ownership percentages 5-3-2. Well, 50% of 342,000 is 171 grand right here, 171 grand. So already, what does that do? It puts Nixon into the red. And what we have to first do is replenish his account, that $1,000. And that $1,000 is going to get split over the last two partners who are still solvent. And it's going to be split on the 3/5, 2/5 basis. So then when it's all said and done and there's 8 grand to give up, Nixon will get nothing. Most of it's going to go to Cleveland and the balance to Pierce. And what that does is it's not saying that we're going to get nothing for those assets after those liabilities are paid, but it's just saying if we got nothing, the correct way to disperse that is by giving it to Cleveland and to Pierce based on what they have for reported balances in their capital account. Is there any questions on number 12? Understand what we're trying to accomplish there? It's a very conservative approach. Amanda, yeah. Go ahead, Amanda. Oh, I'm sorry. Okay, was that you, Macy? Go ahead. There is no safe payment of 350. It's just saying when you take cash plus the assets minus the liabilities, that's 350. Or a real quick way is you add up those 3 capital accounts, that's 350, right? And that's really what the partnership is worth. And what it's saying is we're not going to be able to disperse all 350. In fact, we're only going to be able to disperse $8,000. So the difference between the 350 that's on the books right now and what's really, really available is 8. That's a $342,000 loss. And those losses had to be spread like they normally are. And then who is able to get the money? So if we don't factor that loss, Nixon, if we would have just said, okay, take that $8,000 and do it on the 5-3-2 basis, Nixon would have got a check for what? 4 grand, right? And that would have been overpaid because after that, if we would have figured the loss, whether it was an operating loss, which this is a non-operating loss, it's a sale of an asset, there's $342,000 worth of a loss to disperse, and Nixon didn't absorb any of it. Well, he was supposed to absorb 50% of that loss, and that 50% would have put him into the deficit, okay? Because if you look here, that 50% loss, I don't know if you see my cursor right there, that $171,000 is 50% of this number right there. Well, that alone put him into a red category. Well, he should get nothing then because he can't even absorb the loss. And the other 2 partners had to cover for him. So the person that would have been the most upset would have been Cleveland, right? Because Cleveland should have gotten the vast majority of it, but he also had to absorb the loss, partial loss of Nixon, and so did Pierce. Anybody? Yeah, go ahead. That's exactly, it's just safe. So what are they going to do today? They'll write a check for $6,800 and $1,200. Does that mean that that's where it's going to stay? Absolutely not, and most likely not, because this other asset for $540,000, it's probably a building, and after they get the building sold, and it'll take some time, they're going to probably get, let's just guess low, $500,000. Well, a $500,000, the first thing they're going to do is pay off that liability, right? And then they're going to have quite a bit of cash, plus the other cash. So after you see, well, there's $70,000 of cash in there. Well, the first thing that 70,000 should go to is that liability, right? Your liabilities have to be paid first. Okay, unless there's another question, I'm gonna close. Yeah, go ahead, Brendan. That's exactly right. So right now we got 5 plus 3 plus 2, which is 10, right? So 5 tenths, 3 tenths, 2 tenths. But after Nixon's out of the picture, we only have the 3 and the 2. So it has to, in order to make it be 100%, we got to do 3/5, 2/5. You got it. Yep. So here's something that you may see happen on Connect or somewhere else, and I just want to make sure you all see it. Let's look at that 532 again. Let's say it said 531. And a lot of folks say, well, that doesn't equal to 100% or 10 or whatever. That's fine. It just has to be then 5/9, 3/9, and 1/9. And then you cover it 100%. Good question. All right, let's look at number 13. Macy, could you read 13 while I try to figure out how to pull up the next one? Okay. Okay. So in this case, the key is all partners are insolvent, which means all the partners are belly up. They have already essentially are bankrupt. They have no other cash to put in. Their liabilities exceed their assets. So the point is, you can't get any more money out of them. Okay, because the number one thing at first is, like in the previous example, what you could have done is said, Nixon, you pony up $1,000 and then you're not deficit. But the truth of it is, you probably wouldn't ask for that because there's still a gigantic asset to sell. So for him to put money in only to get more back out hardly pays. So they just say, okay, of this $8,000, we're only going to give it to the two partners that are still in the black. Doesn't mean that either or any of them are insolvent and that they have to ask for money. It just means it's a little ridiculous to say, okay, put some money in to make us whole, only to, when we sell that big asset, you'll get more money back. That doesn't make sense. So they just say, well, when we have this little bit of cash, we'll just give it to those that are supposed to get it. So in number 13, letter A, it just says, so if the land was sold for $25,000, how much cash does each get? Well, it had only two assets, cash and land with a basis of 35. So if we sell it for 21, there is a lot, right? No, sold it for 25. If we sold it for 25, that is a loss of 10. So what you do is, you, just like we did in the first problem, lay out their capital accounts. Now we got to split that $10,000 loss on the 4 to 3 to 3 basis, and that gets split 4, 3, 3. So now what is there for a distribution? It sold it for 25. So 25 and the 10, we split that across, and Brown gets 21, Fish 12, Stone 2. Okay? Makes sense, okay, about that one? That one's a nice clean one. That's a nice one. Letter B, it says now they sold it for 15. Well, then that means we have a $20,000 loss, right? Because it had 35 on the books. We sold it for 15. So right here, there's a $20,000 loss. We split that on the 4 to 3 to 3 basis. Again, that gets Brown down to 17, fish to 9, and Stone is in the red. Before we can do anything, we got to replenish Stone back to whole. And then because it was a 4-to-3 basis, the first two partners, it would be 4/7, 3/7, 4-to-3. We split that $1,000. Brown will get 40%. 4/7, not 40%. 4/7, and fish gets 3/7. So then when there's cash to be given, they sold it for 15 and we had 10. 15 plus 10 is 25. That 25,000 is going to get split to Brown, Fish, and Stone. It's being, okay. Questions on B? That's very similar to what we did in the previous example, right? Okay. Then if we go to letter C, it said they sold it for 5, so it's an even larger loss. Well, we had it on the books for 35, so that's a $30,000 loss. How are we going to split that? 4, 3, 3, 12, 9, 9. That gives us new balances of 13, 6, and now a -4. So the first thing we got to do is take care of Stone again. It gets split on the 4/7 to 3/7. It's just a larger loss to split over, and then it gets put this way. I don't know what that loss would need to be. I'm not going to spend the time to figure it out. It's not that difficult. But if in case after we did all of this and like say the second step, if you will, the loss now is 6,500. Well, then if you can tell here, or it was more than 6,500 allocated to fish, it would mean then that Brown would have to make up for both fish and Stone. And we'll do another example where it basically the one partner has to cover all of them. Okay. Anybody have any questions on number 13? Yes, that's that they're getting a distribution because that's essentially, it doesn't close out Brown's or Fish's, but it certainly, it reduces their capital accounts by, for Brown, it would be 14,286 and Fish is going to get 10,714 and Stone, nothing, right? He's not going to get any cash. So, but it's got to, we would do the journal entry showing how their capital counts are reduced. Yep. Anybody else on 13? All right. Amanda, can you do 14 while I try to find it? Okay. So if you look over these accounts here, notice how right out of the gate, we know that these two are negative capital accounts. And usually, before anything would happen, the first question you would say is, you need to make your capital accounts whole, back to zero, at least to zero, okay? And their response is going to be, forget it, because they're going to say, we already got a partnership that's going down the toilet. I'm not going to put more money into a partnership that we're going to dissolve, right? I mean, how excited would you be if you're going to trade in your car and you're not getting anything for it other than the metal, but the dealer says, I'd like you to put on, a whole new set of tires at $250 a piece. So you're going to put $1,000 worth of tires on a car that you're getting nothing for. You're going to say, forget it. Okay, so in this case, who's going to get the cash? Well, let's just list it out here first. 70, 30, 20, 42, and 58. He puts in 20, so now our new capital balances are 70, 30, 42, and his got reduced to, but still unfortunately, a negative 38. Well, then what you got to do is, okay, you add up these 42 and this 38, that's an $80,000 deficit negative that these two partners have to absorb. And how is that going to be absorbed? It's going to be absorbed on the 4/7, 3/7 basis. All right, well, A gets 45 grand, K gets 34 grand, and look at here, unfortunately, what does it do now? It puts K into a negative, which means Atkinson has to pick up his loss as well. So now where are we up? What are we down to? The 20 grand. So though this is a great problem, think about it for a moment. What's going to happen? Rasmussen is going to put in 20 grand only for Atkinson to take it out. So the realistic part of that is it's probably not going to happen, but it just shows in a real severe way that the partner that is probably holding the highest capital balance and the highest ownership percentage is the one that's going to be at the most risk of covering all the deficits, right? They own the most and they have the highest balance. Amanda, you look like you might have a question. All right, good. Anybody else on 14? All right. Brooks, could you read 15? All right. So, so the partners share the profits and losses on that 3-3 to 2-2 basis. What is the safe payments? Okay, so they have, so basically the first thing you do is you say, okay, listen, what do we own and what do we owe? Well, fortunately, we don't owe anything. There's no liabilities, so we can take that out of the equation. But what we still own is land and a building. We don't have to worry about the cash, right? But land and building, there is $85,000, right? $85,000. To be safe, we're going to assume 100% of it is going to be a loss, meaning we're going to get nothing for it, which is not realistic, but we're just being safe. And the other realistic part about these liquidations is when a partnership liquidates, it's going to be down to this kind of stuff, the land and the building, right? That's what's going to be left. And you're going to have to list it with a realtor, and it's going to take, unless you're going to do, you know, a huge rock bottom selling price and then anybody will buy it, you want to get the most that you can for it. So it's going to take a year and a half. However, they're going to say, look, if there sits 10 grand in the bank, let's get rid of that. And the truth of it is you better be safe, because that's probably a little aggressive just to get rid of that 10. So what we're going to say is, to be safe, because we don't know if there's going to be a loss on these two assets, 85,000 is going to be split on the 3-3 to 2-2 basis. And another 5,000, which was those liquidation expenses on the 3-3 to 2-2 basis. To be honest with you, you could have just done a $90,000 split on the 3 to 3 to 2 to 2 basis, right? Because we know those two items together are going to have to be split. Are you with me on that? So ultimately, where do we get down to? Right here. We're left with balances now in their capital accounts of -2, 1,000, 2,000, and 4,000. So what's the first thing you got to do? You got to get ACE made whole. So we'll put 2,000 back into his account to get it to 0. But Ball, Eaton, and Lake are going to pick up that deficit on the, what is that? 3 plus 2 is 5 plus 2 is 7. 3 sevenths, 2 sevenths, and 2 sevenths. So what's there left for cash? There's only 5,000 left, right? Because we had 10, it had to pay another 5. So what do we got left? That's what the partners that are remaining will get. Ball, Eaton, and Lake. It's just making sure we're safe. Now, doesn't mean that we're not going to get anything for land and building, but right now, that's all they're going to get. Questions on that? Exactly. It needs to tie out. I mean, it's not coincidental that it's this way, because in fact, if you add up these 4 capital accounts, that should be the sum of 10 plus 35 and 50, right? Because that equation still has to be right. Assets equals our liabilities and owner's equity, and this time it said there were no liabilities. So good question. Any questions on that one? Anybody? Where did you get your 95? So 10 plus 35 is 45, 95. 95 is the capital, and the capital is 95, correct? Yep. And those 4 capital accounts right there should equal the sum of 10 plus 35 plus the 50. Oh, right here, down here. Yes. Oh, where did that 85 come from? So that 85 is the 2 assets that are not cash. So land of 35 and the building of 50. Because when we close this thing down, we won't get a loss on the cash. And the land and the building is where we could potentially get, 100% loss, which is so unrealistic. You're not going to get 100% loss, but you more than likely, you're going to have some kind of loss because just circumstances. If things were going so great, the partnership, first of all, wouldn't be closing. And if it did, it was because this thing was worth something. But anyway, good question. Anybody else, while you look that over, where we get these numbers from? Okay. Brendan, do you mind reading 16 while I get that one pulled up? Okay. And on the test, it'll ask you to do a schedule of liquidation. And how that looks is just like they have here. which you could use like an Excel spreadsheet. It's your balance sheet, but it's laid out horizontally. So you got your cash, your other assets, AP. So you see that these two assets equals the sum of everything around here, okay? So you have that, and I think what we have to also see, because I think this is important, notice here in the capital accounts, we got Hardwick, Saunders, and Ferris, but look at here, we also have a loan to Ferris. Means the partnership owes Ferris 40 grand. This is not going to go over at all. This will not go over at all. But if you look here, what did we do with Ferris? We took Ferris's loan and capital and combined it. See that? 230. It's not going to go over at all, but that's how it works in a liquidation. If there's any loans or receivables with partners, that's what happens. So now look at over here. Hardwick, there is an accounts receivable for Hardwick. He owes the partnership money. So what do we do there? Notice Hardwick had a capital account of 300. Now he has a capital account of 270. We offset it. Okay, so with Hardwick, we offset it. With Ferris, we added it to his capital account. Does anybody have questions on that? Okay. So we get our new adjusted accounts now. We're getting rid of the intercompany payable receivables with the partners, and we're just combining it with their capital accounts. Okay, that's the reality of it. That's what's going to happen. So now it says we sold these here, this $820,000 worth of other assets, and there's going to be a number of things in there. But what they did say is they sold 40% of them. 40%. Well, using your calculator, 820 times 40% is $328,000. That's the cost basis. So what we do here is we reduce other assets by 328, right? We got the cash for it. Think about the journal entry, which means there's a $128,000 loss, right? That has to be split over these partners on the 4 to 3 to 3 basis. Everybody with me? Everybody follow? Okay. Then what's left in the other assets? $492,000. We're going to assume 100% loss on that. So that gets split across this way. Okay. Also, there's $210,000 worth of liabilities. You got to get rid of that. The 210 goes away, which now drops our cash to 80 grand. We have $80,000 left in the cash account after assuming all losses, all payables. We still have money to disperse. It's a pretty good deal, actually, and it's going to get split on the 4 to 3 to 3 basis of 22, 14, and 44. Questions on number 16? There's a lot going on there. Can you say that one more time? Sorry. Yeah. So then before you did that 80 across, I'd factor in that 10. You bet. Um, and quite honestly, unless you knew that there was nothing in the pipe for bills, nothing, I'm not quite sure that I'd get rid of all of 80 either, because the other assets, even though the other assets of $492,000, you're going to get something for them, you would hope. But if you don't, you have actually not a penny left in your bank account to pay anything going forward. It's safe in that you're not over dispersing to the wrong partner. It's my only comment would be you have literally nothing in your checking account anymore if by chance you forgot some utility bill and now you got a $1,200 utility bill, and how are you going to cover that? The good thing in this case, all the partners appear to be solvent. Okay? Meaning you could ask for, could you guys all pony up your fair share 4 to 3 to 3 basis of this bill? So anybody else questions on 16? Nobody? Okay. Would it change things? I would say it does, to the level of, you know what? I better be careful. I mean, I'm assuming they're insolvent outside of this partnership. So then I would also be a little bit more cautious about giving away everything. You know, if you knew there was a partner that was insolvent, you just realize, right? If you give them everything back, they're going to take that check and they're going to go and buy a boat with it. And then when you get another bill for 10 grand, yeah, you can go and ask for it, but you also know that they're insolvent. They don't have anything. So that's why we do these very safe payment schedules, and then be safe once more, and just be very cautious. So good question. Anybody else on 16? Okay. Macy, can I pick on you again to read 17 while I... Okay. So this is an interesting problem. What they're asking for is, what do we need to do in order for us to get all of us to get something? Or put it another way, what is the lowest we can go and still get out of this thing without me putting more money to get out? So again, all these partners are solvent. All the partners would have to put in money if we, or some of the partners would have to put in money if we sold the assets for so low. So the question is how, because right now, these three partners, Miller, Tyson, and Watson, they hate each other and they want to get out. And their comments are probably something like, I don't care what it takes, sell those other assets for whatever, and let's be done with this because I'm tired of talking to you guys, right? But it changes a little bit when they say, okay, we're going to sell it for $1, but in order for that to happen, so-and-so is going to have to put more money in so we can shut this thing down. Well, then, no, that's not what we want to do. Then let's sell it for a little bit more, because the last thing I want to do is throw good money at bad. I don't want to put money in only to get out nothing, right? So how do you figure that out? You look at your capital account balances, 69, 69, and 20, see that? And then you divide it by their ownership percentages. So 69,000 divided by his ownership percentage of 60, 60%, and you do that for Tyson and you do that for Watson, means that is how much loss they could be allocated before it wipes out all of their capital. Follow me? So if we sold an asset for $101,000, it will eliminate Watson's capital account because of 100, and let me back up, but let's just say it's 100,000. If it was $100,000 loss, he gets 20% of it. 20% of 100,000 is 20 grand. It will wipe Watson out. Then any more loss is going to have to be split by Miller and Tyson. Does that make sense? So the point is this: Miller, Tyson, and Watson hate each other. They all want to get out. They want to sell for whatever just so they can be done. And they sell, just get rid of it. I don't care what you sell it for. Which means if you sold it for anything less than $100,000, it's going to wipe out Watson. And the other assets are on the books for 150, which means you'd be selling it for 50 grand, right? That's a $100,000 loss. And they would say, hold on here. I don't want to do that. Because if I do that, Miller and Tyson are going to have to put up more money. I want to stop there just for a second. Who's got a question about that? So what this does for you, this little calculation right here, it tells every partner before we even begin, what can I absorb for a loss? Or what can my partners absorb before I'm stuck with even more of it? So Miller and Tyson are going to say, we're not selling it for 50 grand or less than 50 grand, because then we're going to pick up more of 100 more loss than what Watson can absorb. I will be picking up more of Watson's loss. Everybody follow that? So that's why it reads, thus, if the loss of the disposal is less than 100,000, all partners will get some cash back. Because of this, and since other assets are 150, they must be sold for any amount over 50. Okay? So what's nice about this problem? What does it tell you, or what does it try to teach you? Is you can look at their capital account balances, divide it by their ownership percentage, and if you incur a loss of that number, that's what will wipe them out. So, Watson can say, I don't care if we give it away, and there's a $150,000 loss. Watson is already belly up. He's not going to put any more money in because he has no more money. But the people that are going to care about that is Miller and Tyson, and even more so Tyson, right? Yeah, go ahead. Well, yeah, absolutely. That's exactly right. Tyson will only be able to absorb his 20 grand, right? And the other two partners are, if let's just say it's 100 grand first of all. That's the loss. 100 grand. So Tyson will get 20. Excuse me. Watson will get 20, Tyson will get 20, and 60,000 will go to Miller. But if we took an entire $150,000 loss, Watson is only going to be able to absorb 20 yet because he has no more money. So if it's a $150,000 loss, it's going to wipe out Tyson. It's going to wipe out Miller. And Tyson, did I say Tyson or Watson? It will wipe out. Go ahead, Brendan. What did I say? Okay. It'll wipe out Watson. It will wipe out Miller. And quite honestly, Tyson is going to be stuck holding the bag. And the only reason he would not be holding the bag is if Miller and Watson both were solvent, meaning they had other resources that they could put money in. But they don't. They're all insolvent. So it's a great question to say, how in the heck could that have happened? How could Miller have $69,000 balance? Tyson has a $69,000 balance and only a 20% percentage ownership. So when you put together your partnership, so this would be kind of going back to 14. And, in 14, we talked about how can you split income? How do you split income? And you can split it however you set it up, meaning, of course, you're going to probably split it based on the 60-20-20. But what sometimes happens is this. If we have a loss, in a year of a loss, then what we would like to do is split it 95% to Miller and 2.5% to Tyson and to Watson. And you'd say, well, why in the heck would Miller take all the loss? Well, first of all, it's a paper loss, right? Because it's on a K1, because the partnership's taken care of all of their revenue and expenses, but it gets to a loss. Well, if you have no other gains on your personal tax return to offset that loss, it goes nowhere. It kind of gets suspended. However, let's say it's Miller. Miller has all kinds of other partnerships going that have gains. Well, he would love to have all of that loss, because that loss would offset other gains that he has on his personal return. So it's in the whole partnership agreement, how it's set up, that if income is split 60-20-20, but losses potentially could have been split 90 and 5% and 5%. I'm just guessing here, but otherwise you're exactly right. How in the world can that, you look at those capital accounts, how can that be so distorted? But that would have to be what happened. So anybody else on number 17? Brooks, you have a question? I can't see you right now, and that's not because of you. I don't. Okay. All right. Okay, folks, I think that's a good stopping point, because there was a lot today. So what I'd like to do, or just so you know what we got on the docket then for Thursday, if you join me, is we're going to look at 18 and 19. And then I just want to make sure I have this out there. Right here, do you see my cursor here? Look at number 21 also. Okay, we're going to do number 21. And I don't believe I have a video on 21, but that's fine. You can read it and then look at the solution for 21. Any questions on what we'll do then on Thursday? I think, not to stop you, but I think you've asked too many today. So no, go ahead. Oh, that's right. Yes, the numbers are different, but the whole concepts are still the same. Yes, yes. So you're talking, what I did on the video is different, and probably even what's attached here. Yes, they're different numbers, but, and you're exactly right. I was going to make a note of that because I have a different color in my textbook to tell you, and I forgot. 18 and 19 are the only two that are different. Yes. Thanks for bringing that up. And 21, I am pretty certain I don't have a video on that, but that's okay. It was just, for all practical purposes, just given to people who are going to go over it. So. Any other questions? So let me kind of give you a little bit of the extended forecast here. Bear with me here. I'm going to stop sharing my screen. I don't know. Am I back? Okay. Okay. So you know, so on April 2, which is Thursday, gosh, it's April already, we'll finish this chapter. Then this next exam is really over just chapters 14 and 15. 14 and 15. 11 is complete. This is how I've always done it. 11 is on IFRS and International Accounting Standards. And since it's not completely set in stone yet, I'm not going to go into great lengths on that, but I do want you to be aware of what's going on out there, what's the talk and just kind of all of that. So what I do for 11, that is completely an open book thing where you take a test over that and you have all your resources. You just look in the chapter for those answers for those questions, but that is completely with all your resources, because it's not something I believe that it's fair to test over yet. That's still a moving target, but I do want you to know what's moving on out there, so it's not completely clueless to you what's going on. So you don't need to worry about 11 because you'll see that review sheet's out there and it says 11, 14, and 15, but 11 is never tested on Connect, okay? So kind of just to manage time so that you don't get so overwhelmed, what we probably will first do, so after this week, next week, we'll have your take-home portions of your Connect like we did last time. That would only be due on next Tuesday. And then your actual, what we would have done, your in-class portion, that'll be done on Thursday. There's not 2 days like the first exam. Remember what we did? Remember how much you loved that, doing it for 2 days? Oh no, that's right, you didn't. So this time you only have 1 day of an in-class. Come here. This is my daughter, Matea.
Hi.
No, hold on. She doesn't want to be here because she just probably rolled out of bed. See, you guys are up already. Matea turned 21 today. So I don't want to know what's happening tonight. Anyway, so on Tuesday we'll have that take-home portion stuff be done, but on Thursday is when we'll actually do the, if you will, the in-class, which will all be on Connect. So, any questions for me? Okay, then I will make sure I get this posted. It'll be a different kind of link now. It'll look like YouTube, but it'll be done. So, hey, thanks guys. Have a good day. All right, see ya.
Sorry,
Hold on.